What are tax incentives on housing? Have you ever wondered how the government encourages the construction of new homes or the renovation of old ones? Tax incentives on housing play a significant role in this process. These incentives are government measures aimed at encouraging investment and making housing more affordable. They help reduce the tax burden on developers, investors, and homeowners, ultimately stimulating the housing market. In capitalist economies, tax incentives serve as tools to align private investment with public housing goals. They help reduce financial risks for private developers and investors, making housing projects more appealing. This is especially important in a market where the demand for affordable housing often exceeds supply. One common type of tax incentive is property tax exemptions. These exemptions can be temporary or partial, lowering ongoing costs for developers. For instance, New York City introduced a property tax exemption in 1921, which led to a significant housing boom. This example shows how tax relief can motivate private sector activity to meet housing demand. Another key incentive is the low-income housing tax credit. This program provides dollar-for-dollar reductions in federal income tax liability for investors who finance affordable rental housing projects. These credits help cover a large portion of development costs, making affordable housing projects more attractive to investors. However, some critics argue that these credits can increase overall project costs and suggest that reforms to reduce regulatory barriers might be more effective. Community development tax credits are also noteworthy. Programs like the proposed neighborhood homes tax credit and workforce housing tax credit aim to stimulate development in distressed or moderate income areas. These incentives can create economic activity, generate jobs, and boost wages, showing how tax policy can mobilize private capital for broader benefits. Public-private partnership incentives are another approach. Some states use tax-exempt entities, like public facility corporations, to create partnerships. In these arrangements, private developers receive tax exemptions in exchange for providing affordable housing units. This method combines private sector efficiency with public affordability goals. From a capitalist perspective, tax incentives on housing help correct market failures, such as the lack of affordable housing. They make housing projects more attractive without direct government involvement. By encouraging private investment and stimulating construction activity, these incentives can contribute to economic growth through job creation and increased wages. However, critics within capitalist frameworks often stress the need to minimize market distortions. They argue for ensuring that incentives do not crowd out market-driven housing solutions. Many advocate for complementary reforms, such as reducing zoning restrictions and property taxes, to allow housing markets to function naturally alongside targeted tax incentives. In summary, tax incentives on housing are a strategic use of fiscal policy in capitalist economies. They aim to balance private profit motives with the public need for affordable and adequate housing. By understanding these incentives, we can better appreciate their role in shaping the housing market and addressing the challenges of affordability.